Hey there, and welcome back to the deep dive. It's been a bit like watching a high-stakes poker game lately, hasn't it? All this back and forth on tariffs.
Yeah, definitely chaotic.
The Dow took a bit of a tumble recently, and the president's take. Apparently, anyone worried is just a panic-in.
Hmm. Strong word.
Okay, so let's unpack this, because beneath that, well, that colorful description lies a really complex and frankly pretty important issue about how the world of trade actually works.
Indeed. At its heart, a tariff is, well, it's simply a tax. It's levied on goods that are brought into one country from another.
Right. Imports.
Exactly. And these have been around for centuries, really. Governments have used them for a few key reasons: to generate revenue, obviously, to shield domestic industries from foreign competition, make imports more expensive,
And I guess as a bargaining chip.
and as a tool in international trade negotiations. Yeah, that's the third one.
Right. And it's that last one, the negotiation angle, that seems to be front and center in a lot of the recent discussions.
Just like it.
But what we really want to dig into today in this deep dive, and we're drawing from recent tariff announcements and a good look back at the history of trade policy, is why there's this growing sense that the president's understanding of the intricacies of international trade might be, well, let's just say there are some significant debates and differing economic perspectives on it.
Precisely. A core idea that seems to underpin the president's approach is this notion that international trade is like a zero-sum game.
Zero sum, meaning the thinking goes that if one country sells more to another than it buys, then the first country is winning, right? And the second is losing. Simple as that.
Yeah, it's like viewing the global marketplace as a giant sports arena where we absolutely have to have a higher score than everyone else, always winning.
Exactly.
But here's where it gets really interesting, because that's not really how most economists see it. Not at all.
No, not typically. It reminds me of this joke I heard from a Nobel Prize-winning economist. He said something like, I have a terrible trade deficit with my local coffee shop. I buy coffee from them every day, and they've never once bought a podcast from me.
Huh. That's actually a great way to put it.
It really highlights how odd it is to think that every single transaction, or even the overall flow between nations, needs to be perfectly balanced for both sides to gain something.
That's a fantastic analogy, really. Because think about it. You value the coffee more than the money you pay.
Yeah.
Right? And the coffee shop values your money more than the coffee.
Sure. Otherwise, I wouldn't buy it.
Exactly. Both parties benefit. It's a positive-sum exchange. And similarly, countries trade because it's usually mutually beneficial. One nation might specialize in cars, another's great at growing certain crops.
It's like comparative advantage.
Precisely. Trade lets both access more goods, often cheaper. It's a core economic principle, really, this mutual benefit through specialization and exchange. And that seems quite at odds with the zero-sum view.
And this conviction, this belief in tariffs to fix these perceived imbalances, it isn't a new thing for the president, is it?
Oh, no. Not at all.
I remember seeing statements he made way back maybe 2011. He was already talking about like a 25% tax on goods coming from China.
That's right. So this isn't just a spur-of-the-moment idea. It's a really long-held belief. It goes way back.
Right. A core belief.
Indeed. And when these deeply held beliefs get translated into actual policy, well, that's when we start to see some, shall we say, unintended consequences.
Okay, like what?
Well, consider the recent tariffs that were reportedly linked to the size of the trade imbalance. The bigger the deficit with a country, the higher the tariff.
On the surface, that might sound logical. Maybe. Tackle the biggest problems first.
Maybe. But the way it was implemented led to some truly perplexing outcomes. Really strange results.
Oh, you mean like the situation with Lesotho? That one definitely raised some eyebrows.
Exactly.
Yeah.
For anyone needing a quick geography refresher, Lesotho is a very small, landlocked country in southern Africa.
Tiny trade partner for the U.S.
Minimal, really. We primarily import apparel, some diamonds. They buy very little from us. So the imbalance, proportionally, is huge.
So when these tariffs, based purely on that imbalance percentage, resulted in something like a 50% duty on their goods.
Well, yeah, eyebrows were raised.
Because what's fascinating here is that Lesotho simply doesn't have the economic capacity, the means, to suddenly start buying huge amounts of American goods just to balance the books.
Of course not. It's a developing nation.
Right. Specific needs, limited resources.
Yeah.
So the immediate effect of those incredibly high tariffs is likely just higher prices for American consumers, people buying clothes or diamonds sourced from Lesotho.
It doesn't actually change Lesotho's behavior, does it?
Not really, no.
Right.
It primarily just makes things more expensive for us here. It highlights how a blunt instrument, like tariffs based only on the trade gap, kind of fails spectacularly when you apply it to these nuanced situations, like developing economies. It ends up hurting U.S. consumers without really achieving the stated goal. Exactly. It's like trying to fix a leaky faucet by, I don't know, hitting it with a sledgehammer.
Yeah.
You might stop the drip, but you've caused a lot more damage.
Good analogy.
And then there's the confusion, the mixed signals about what these tariffs are even for. Was the goal to set up permanent barriers, protect American industries long term? Or was it all just a big negotiating tactic, a way to sort of strong arm other countries into giving us better deals?
And this is a really important distinction because those are two fundamentally different strategies, right?
Completely different.
If the goal is permanent barriers, businesses need to completely rethink their supply chains.
You mean where they get parts, where things are assembled?
Exactly. That whole intricate network. They might need to think about reshoring, bringing production back home. And that's a massive, expensive, time-consuming undertaking. Years, potentially.
Okay, so that's option one.
But if, on the other hand, it's all just about gaining leverage in negotiations, well, then businesses are just left hanging, aren't they?
Yeah, total uncertainty.
Constant uncertainty, not knowing when or if these tariffs might suddenly disappear or change. And that lack of clarity, that itself can be incredibly damaging to the economy. Businesses just pause. They wait and see.
Absolutely. Okay, let's dig into that first idea a bit more, the permanent barriers argument. The assumption seems to be, hey, we can just make everything here in the U.S.
Right. Bring it all back home.
But the reality is, for many goods, that's just, well, it's not practical, is it? Even the former Commerce Secretary kind of admitted this when he talked about mangoes.
Yes, that was quite telling. He basically pointed out, you can't really grow mangoes in, say, North Dakota. It's not feasible.
Obviously not.
So if you slap a tariff on imported mangoes, all you really do is make mangoes more expensive for Americans. It's just another tax, basically. There's no boost to domestic mango farming because it doesn't exist on that scale.
And yet mangoes weren't initially exempt when the tariffs first dropped.
No, they weren't, which is odd.
It's almost funny if it weren't for the real economic hit. And it's not just fruit, obviously. Think about electronics, like the Nintendo Switch 2, hypothetically.
Oh, yeah.
There was huge anxiety when these tariffs were looming. Nobody knew how much they'd cost, if they'd even be shipped here. And analysts pointed out virtually none of the parts or assembly for something like a Switch happens in the U.S.
And what's really key there is the sheer complexity of these modern global supply chains. It's mind-boggling.
Right.
For a product like the Switch, you've got components coming from dozens of different countries, specialized factories. It's not just a matter of building one factory here. You need the whole ecosystem.
All the specialized suppliers.
Exactly. And that whole system has been built up, mainly in Asia, over decades. Experts were saying it would take many years and tens of billions of dollars just to begin replicating that kind of infrastructure here.
Tens of billions. Oh, wow.
And even then, you'd likely still be importing many of the really specialized parts. So the core insight is just how deeply interconnected and specialized global production has become.
So this idea of suddenly reshoring all that manufacturing, like overnight, or even in a few years, it's not realistic.
Not really, no. And even if we could bring some jobs back, we have to think very seriously about the risk of retaliation.
Ah, yes, the counterpunch.
This is a pivotal point. It happens almost every time. When the U.S. puts tariffs on another country's goods, that country usually hits back. They impose their own tariffs on American exports.
We saw that play out pretty clearly before, didn't we, with the China tariffs in the first term?
Absolutely. American farmers, for instance. Think about soybean growers in Tennessee.
Yeah.
Many had spent decades building relationships, building markets in China.
Yeah, long-term business.
And then, bam, retaliatory tariffs hit their soybeans hard. Suddenly their biggest market gets slammed shut or becomes way more expensive.
It's truly disheartening. You think about these businesses, sometimes family businesses built over generations, suddenly caught in the crossfire of these big international disputes.
It's a huge risk.
And that leads us to the other main justification we hear for tariffs, that they're just a tool, a way to get negotiating leverage.
Right. The bring them to the table argument.
The idea is you hit them with tariffs, and suddenly everyone comes running, eager to strike a deal on our terms.
That was certainly the narrative coming from the White House after the recent pause on some of the tariffs. The Treasury Secretary even said something like over 75 countries had come forward to negotiate specifically because of the tariffs.
Okay. But here's the thing. They haven't actually released a list of these 75 countries.
Yeah. No list has been forthcoming, no.
Which does make you wonder, doesn't it? A little bit.
It does raise questions.
Hmm?
And even with this supposed pause, we still have a 10% tariff sitting there on imports from a whole lot of countries.
Including countries we actually sell more to than we buy from, countries where we have the trade surplus.
Exactly. So it's not entirely clear what better deal we're trying to force in those situations. It doesn't really fit the fixing the deficit narrative there.
It doesn't add up.
And when you look at the really big, complex disputes like with China, the issues go way beyond just the trade balance numbers.
Right. It's not just about who sells more widgets.
No. There are serious, legitimate concerns about subsidies China gives its own industries, which can distort markets. There are big allegations of intellectual property theft.
Stealing designs, patents.
Exactly. Unauthorized copying or use of inventions, creative work, and other complex practices. Fixing those things needs really careful, nuanced diplomacy. It needs a coordinated strategy, probably involving our allies.
Allies we might need on our side.
Allies you definitely need leverage with. And it requires a deep understanding of China's own motivations, their strategic goals.
And that seems to be where the current approach has maybe fallen short, by sort of antagonizing allies instead of bringing them on board.
Well, arguably, yeah. By going it alone with broad tariffs, we've potentially weakened a key source of leverage. It's a bit like, trying to win a team sport by refusing to pass the ball. You need your teammates. And furthermore, China's leverage here isn't just about hitting back with tariffs on soybeans. They have other cards to play.
Like what?
Like their significant control over the supply of rare earth elements.
Rare earths. We've talked about those before. Crucial stuff.
Absolutely critical for everything from wind turbines and renewable energy tech to advanced electronics like computer chips, even for defense tech like fighter jets.
So if they decided to restrict access to those,
it could have really severe consequences for the U.S. economy and even national security. That's significant leverage they hold, totally separate from tariffs.
And it probably doesn't help smooth things over when U.S. officials make comments that are, let's say, less than diplomatic.
No, probably not. Some remarks made recently were reportedly very poorly received in Beijing. Just adds friction to an already strained relationship.
It's like trying to build bridges while, simultaneously setting fire to the other end.
Not the most effective strategy, perhaps. So, considering all this, it's really useful to look back at history. This isn't the first time we've gone down this road with tariffs. What actually happened before?
Right, the first term tariffs on things like washing machines, steel.
Exactly.
And proponents will point to maybe some modest job gains in those specific sectors, a few thousand jobs here or there in steel mills or washing machine factories.
They do point to that. But when you dig just a little deeper into the economics, what do you find?
Well, what's fascinating is the cost of those jobs to the broader American economy. Some credible studies estimated that American consumers and businesses effectively paid hundreds of thousands of dollars per year for each of those jobs reportedly created or saved by the tariffs.
Hundreds of thousands. Per job, per year.
Per job, per year. That's an extraordinarily high price tag. And that figure doesn't even factor in the potential net job losses in other U.S. manufacturing sectors.
How so?
Because those other industries, the ones that use steel, for example, suddenly faced higher costs for their raw materials. Right. Car manufacturers, construction, appliances.
Exactly. Higher costs for them could mean less competitiveness, maybe fewer sales, and potentially shedding jobs, maybe even more jobs than were gained in the protected industry. It's that ripple effect.
A ripple effect that might lead to a net loss of jobs overall.
It's a real possibility, often overlooked in the initial headlines. And then we had that first big round of tariffs on China. Yes, they brought some money into the U.S. Treasury, right,
but a huge chunk of that revenue, some estimates put it over 90%, was then immediately paid out as bailouts, financial aid to American farmers. The same farmers hurt by the retaliation we talked about.
The very same. The ones hit by China's counter tariffs on agriculture. So it's a bit like collecting money with one hand and then immediately handing almost all of it back out with the other.
Doesn't sound very efficient.
Not particularly. And let's not forget the promises made back then in the trade deal with China. They supposedly committed to buying billions more in U.S. goods.
Did they?
Well, subsequent analysis pretty clearly showed they fell well short of meeting those purchase commitments. They effectively didn't do it.
So, looking back, the historical track record for these kinds of broad tariffs, It's not exactly a glowing success story, is it?
Not based on that evidence, no.
Hmm.
And perhaps one of the most concerning long-term consequences of all this recent tariff activity, beyond the direct economic costs, is the erosion of global trust.
Trust in the U.S.
Trust in the stability and reliability of the American economy as a trading partner. This is the profoundly important point. It goes beyond specific deals.
How so?
It's about the predictability of a whole international system. Remember the statement from the Canadian Prime Minister after the initial tariffs were announced?
Vaguely. What did he say?
It was quite stark. He basically suggested this marked a fundamental shift in the global economic landscape. He said the post-World War II trade system, the one largely built and anchored by the U.S., was effectively over. Tragedy is the new reality, I think was the quote.
Wow,
Oh, yeah.
that's a heavy statement. From Canada, no less.
A very close ally. And it wasn't just politicians. Financial markets sent a really worrying signal, too.
You mean the stock market drop?
Well, yes,
Right.
but also how it dropped.
Yeah.
At one point, both stock prices and U.S. government bond prices were declining at the same time.
Okay, why is that significant? Usually bonds go up when stocks go down, right? The safe have an idea.
Exactly. Normally, bonds are where investors flee when they get nervous about stocks. But when both go down together, it suggests a broader loss of confidence, not just in company profits, but maybe in the overall stability and future of the U.S. economy itself.
So people selling off U.S. assets generally.
It signals a potential loss of confidence, yeah. Maybe even questioning the U.S. dollar's role, the reliability of U.S. debt. It suggests investors, maybe even foreign central banks, are starting to question the long-term stability and credibility of the U.S. as this anchor of the global system.
That's deeply concerning.
It is. And while we have seen this recent pause put on some of the tariffs,
Yeah, it came pretty abruptly.
very abruptly, but the underlying issues, the potential for more disruption, they haven't just vanished. The uncertainty is still there.
No, the messaging from the administration still seems kind of mixed, doesn't it? Unclear about the long-term plans. So that very uncertainty, the thing that's been so damaging, it's still hanging over everything.
Absolutely. What's fascinating is that despite the pause, the fundamental questions about the strategy, about where this is all going, they remain unanswered. The potential for more economic turbulence here and abroad, it hasn't gone away.
Okay, so to try and wrap this all up, it really feels like the immense complexities of international trade, all those ripple effects, the potential for unintended negative consequences, they're being, well, perhaps significantly underestimated.
That seems to be a fair assessment based on the outcomes we've seen and the standard economic understanding of trade.
The idea that you can just impose these broad tariffs and expect only good things without deeply considering the global supply chains, the near certainty of retaliation, the impact on allies and global trust, it does seem to point to a fundamentally different perspective on how the global economy actually works.
Precisely. And this, I think, raises a critical question, maybe the key question for you, our listener, to ponder. Given the history we've talked about, given the current global landscape, what do you see as the likely long-term implications of continuing down this path, of approaching trade with this primarily unilateral protectionist strategy?
Yeah, what does it mean long term? Not just for the U.S. economy, but for global economic stability, for the future of international cooperation.
Some really vital questions to think about.
Definitely. We really encourage you to explore the dynamics of international trade further. Maybe look into different economic viewpoints on trade policy and really form your own informed opinions on this. It's crucial stuff. Thanks for taking this deep dive with us today.